Welcome to the deep dive. Today, we're really digging into something foundational for investors, 101 years of global investment returns.
Yeah, we're looking at the book Triumph of the Optimists. It's this incredible study covering equities, bonds, bills across 16 countries, all the way from 1900 to 2000, and crucially, inflation too.
Think of this as your shortcut, right? We're boiling down this massive amount of research to give you the key long-term insights, maybe some surprising facts, without you having to wade through all the raw data yourself.
Exactly. And the quality of the data is, well, it's pretty remarkable. They went back to original sources, which is a huge undertaking.
And they set a common start date, 1900, for everyone, which makes comparisons much cleaner. Plus, they include reinvested income total return, basically.
Which is vital. And look, this isn't just history. Understanding this century gives you context for thinking about future returns.
Right. And it affects corporate finance decisions, even government policy.
Definitely. And a key point right off the bat, you can't just look at the U.S. market's incredible run and assume that's the norm everywhere else.
That's a huge potential mistake, isn't it? Extrapolating just from the U.S.
It really is. This long-term global data is what you need for estimating expected returns, not just focusing on, short-term blips or volatility.
Okay, so let's set the scene. World markets then and now. These 16 countries in the study, they're significant.
Oh, absolutely. They represented over 88% of the world's stock market value at the end of the study, and they were dominant back in 1900 too. So it's a really representative slice.
And for each one, they looked at stocks, bonds, bills.
Yep. Equities, bonds, bills, inflation, local currency performance, and they even pulled together GDP data for the whole century. It's comprehensive.
Let's talk bonds for a second. How big are those markets compared to stocks?
Well, at the start of 2000, global bonds were about $31 trillion. Equities were $36 trillion. So bonds are, almost as big.
Wow.
Yeah, and government bonds make up the majority, maybe two-thirds of that. Trading volumes in bonds often exceeds stocks in many developed countries.
But the size relative to the economy, relative to GDP, that varied a lot.
Hugely. Like you mentioned, Ireland was around 34% of GDP in 2000, but the U.S. bond market was way up at 159%.
What causes such big differences?
It really boils down to things like government policy, how much the government borrows, privatization efforts, and also whether the economy relies more on banks for funding or on capital markets, like issuing bonds. Countries with big public sectors tend to have more government debt out there. Makes sense, right?
Yeah, that follows. And stock markets, they do more than just let people trade shares.
Oh, definitely. They're crucial for companies raising capital, obviously, but also for individuals saving and investing, diversifying.
Regulation too, I suppose.
Regulation, information flow, price discovery, figuring out what companies are worth. They're vital economic engines.
And they've been around a while. Amsterdam, Frankfurt.
Yeah, Amsterdam way back in 1611, Frankfurt later that century, Paris formalized in 1724, London in 1801. These things evolved.
Was international investing a thing back in 1900?
Surprisingly, yes. Europeans were quite active investors in what we now call emerging markets, or at least less developed countries back then.
But that changed.
It dipped significantly mid-century, wars, economic turmoil, capital controls.
All right.
But then it picked up again from the 1970s onwards.
What about the types of companies dominating the market? Big shifts there.
Huge shifts. Railroads were dominant in 1900. Think about that. By 2001, it was tech, pharmaceuticals, much more diverse.
Though some sectors hung around. Banks, utilities.
Exactly. Some continuity, like banks, utilities, they remained important. But these sector shifts are a big reason why different countries' markets performed differently and had different risk profiles over time.
Is market concentration a few big companies dominating a new worry?
Not necessarily new, no. It varies a lot by country and over time. The UK's concentration increased, for example, but it wasn't, historically off the charts, and it's lower than some others.
So maybe less of an issue now with global investing.
That's the author's point, really. If you can easily build a global portfolio, the concentration in your home market matters less than the diversification of your total holdings.
Okay, that paints a good picture of the markets. So how do we measure the returns reliably? Avoiding the pitfalls.
Yeah, this is critical. How you build the index matters hugely. You have to watch out for biases that make the past look rosier than it was.
Like survivorship bias.
Exactly. Only looking at companies or markets that survived. And success bias is focusing only on the markets that did well, like the U.S.
Forgetting the ones that failed or stagnated.
Precisely. And then there's easy data bias.
Just using what's readily available.
Right. Often that means starting after World War II, which again can skew the long-term picture, usually upwards because it misses earlier, rougher periods.
So how did the Triumph researchers tackle this?
They aimed for really broad coverage, ideally the whole market in each country. That's tough for 1900 data, obviously.
I bet.
So they used the best available series. For the US, there was good data from Wilson and Jones. For the UK, though, they actually had to hand collect data and construct their own index for the period before 1955, based on the top 100 firms then.
Wow, it's dedication.
It really is. And key for international comparisons was getting a broad set of countries, not just US, UK, and putting everything into a common currency, US dollars, to compare apples to apples.
So they built a world index.
Yep. GDP weighted for bonds, and equity market cap weighted for stocks where they could get the data. And crucially, adjusted for US inflation to get real US dollar returns. It's a solid approach to see the big global picture.
Okay, methodology sorted. Let's get to the juicy part.
Yeah.
The actual historical returns. What did they find? What are the big numbers?
All right, let's start with the US, 1900 to 2000. Equities were the clear winner, 10.1% per year nominal return.
And after inflation, the real return.
That was 6.7% per year, compounded, still very strong.
And bonds and bills.
Bonds came in at 4.8% nominal, which is 1.6% real. And Treasury bills, the short-term stuff, 4.1% nominal, only 0.9% real.
So bills barely kept ahead of inflation over that whole century.
On average, yes. Inflation itself averaged 3.2% in the US. So the key thing for you is seeing that spread. Equities delivered significantly more than bonds, which delivered more than bills after inflation. But again, that US equity number is exceptionally high globally.
How did the UK compare? Still a major center, but maybe different challenges.
More modest returns in the UK, definitely. It reflects the economic difficulties the UK faced during parts of the 20th century. It really highlights that even major markets don't automatically track each other over the very long run.
And the classic risk-return relationship held up. Stocks riskier but higher return.
Generally, yes. Equities showed the highest average returns, but also the highest volatility, the most risk. Bills were the opposite end.
And diversification helped.
Significantly. Spreading your money across different assets reduced the overall bumpiness, the risk. An interesting side note, they found you needed more stocks to get the same diversification benefit later in the century compared to earlier.
Huh. Okay. Inflation, you mentioned the U.S. average. It must have been a huge factor globally.
Massive. You absolutely have to think in real terms what your money can actually buy. Germany's hyperinflation in the 1920s is the extreme example, right?
Wiped people out.
Completely wiped out the value of cash, bonds, anything fixed in nominal terms. But Germany also had periods of very low inflation later on. So nominal returns are just numbers. Real returns are what matter for your purchasing power.
What about treasury bills? We think of them as safe. Were they always?
Well, safe in terms of default risk in most developed countries, yes, but not safe from inflation. As we saw in the US, real returns were low. In several countries, they were even negative over the whole 101 years.
Negative real returns. Ouch.
Yeah. And the German hyperinflation shows even bills aren't totally risk-free in extreme crises.
Okay, what about longer-term bonds? Less inflation risk than bills.
Not necessarily less inflation risk, actually. They lock in payments for longer, so unexpected inflation down the road can hurt them just as much, if not more. They generally don't have default risk in developed markets, but that inflation uncertainty is key.
And how did real bond returns look across countries?
Very varied. Germany, again, was a poor performer here over the long haul because of that early hyperinflation and other issues.
You mentioned the maturity premium for bonds, getting paid extra for holding longer-term ones.
Right, the idea that you should get a higher return on long bonds than short-term bills. But the study showed this premium jumps around a lot year to year.
It wasn't consistently positive.
No, it could even be negative sometimes, which feels wrong intuitively, but it can happen if markets expect rates to fall significantly, for example.
What about those inflation-indexed bonds, like in the UK,
Yeah.
designed to beat inflation?
Yeah, the UK introduced them in 1981, but interestingly, their performance since then, up to the study's end, showed a pretty poor, even negative real-term premium. So they didn't necessarily give you much extra return over regular bonds once you factor in inflation protection.
And corporate bonds. They must offer something extra for the default risk.
They do, yes. There's typically a default risk premium baked into corporate bond yields compared to government bonds. Investors demand that extra return to compensate for the chance the company might not pay them back.
Okay, shifting gears. International investing. Exchange rates must play a big role.
A huge role. If you invest overseas, the value of that foreign currency relative to your own currency directly impacts your final return when you bring the money home mentally or actually.
And those movements were significant.
Oh, yeah. The study shows massive variation in how currencies moved against the US dollar over the century, both across countries and across different time periods. Big
Is
swings.
there any long-term logic to it? Like purchasing power parity?
PPP, the idea that exchange rates should adjust for inflation differences. It's not great short term. Currencies can deviate for ages.
Oh, long-term.
It seems to hold up a bit better over the very long run, according to the study. Real exchange rates, adjusted for inflation, were relatively more stable. Things tend to sort of revert towards reflecting relative prices eventually.
So does it matter much if we look at real returns in local currency versus, say, real US dollar returns? Does the ranking change?
Interestingly, not that much. While the specific numbers change because of currency moves, the ranking of countries by their long-term real equity returns was pretty similar, whether you used local currency or a common currency like the dollar.
Which suggests the underlying economy is the main driver.
Seems that way. The fundamental performance of the country's businesses matters most over these long horizons, more than the currency wiggles.
And this all reinforces the case for global diversification.
Absolutely. It's one of the clearest takeaways. Spreading investments internationally helps lower your overall portfolio risk. The world indexes in the study for both stocks and bonds had lower volatility, lower standard deviation than the U.S. market on its own.
Even though the US was relatively stable compared to some.
Even so, yes, diversification benefit was still there.
But don't markets all fall together in a crisis? Does diversification still work then?
That's a fair point. Correlations do tend to spike during crises. Markets become more synchronized on the way down.
So the benefit disappears when you need it most.
It might reduce temporarily, but the long-term data still strongly supports diversification. Over decades, holding assets across different economies smooths the ride, even accounting for those crisis periods.
We talked about international investing being common in 1900, then dipping, then returning. What about now? Are we fully globalized, or is there still a home bias?
Oh, there's definitely still a strong home bias. Even with easy access to global markets, most investors tend to overweight assets from their own country quite heavily compared to, say, its weight in the global market. Old habits, familiarity, maybe currency concerns play a role.
Okay, we've looked at broad markets. What about drilling down, like company size? Does that matter for returns?
It seems to.
Yeah.
Historically, the small cap effects, smaller companies outperforming larger ones, showed up pretty clearly in the US and UK data over the long run.
But it's not guaranteed.
Definitely not. It's been volatile, that premium. There have been long periods where large caps did better, so it's not a free lunch, requires patience.
And the value versus growth debate. High dividend stocks versus high flyers.
The evidence in the book strongly favors value investing over the long haul. Stocks with high book-to-market ratios or high dividend yields the value characteristics generally outperformed growth stocks in the US and UK.
And internationally.
Mostly, yes. The value premium seemed to exist in most of the other countries studied too, though maybe not quite as strongly or consistently everywhere.
Fascinating stuff. Now, dividends. We focus on stock prices day to day, but how important are the actual cash payouts?
Critically important for long-term total returns. The book really drives this home. If you just look at price appreciation, you miss a huge chunk of this story.
The power of compounding those dividends.
Exactly. The difference in your final wealth after 101 years between reinvesting dividends and spending them is just astronomical. It's where a lot of the long-term return actually comes from.
But how have dividends grown over time after inflation?
That's been more mixed. Real dividend growth has been quite volatile, and surprisingly, it was quite low in the U.S. during the booming stock markets of the 80s and 90s.
Really? Why was that?
Well, there's been a trend, especially in the U.S., towards companies doing more stock buybacks instead of raising dividends, returning cash to shareholders that way. Some call it disappearing dividends.
How does dividend growth stack up against overall economic growth, like GDP?
Generally, real dividend growth globally has lagged behind GDP per capita growth.
So a fast-growing economy doesn't automatically mean fast-growing dividends for investors.
Counterintuitively, no. The study found little correlation, sometimes even a negative one. High economic growth doesn't necessarily translate directly into high real dividend growth. Lots of other factors are at play.
All right, this leads us nicely into maybe the biggest concept here, the equity risk premium.
Ah, yes, the ERP. the bedrock of so much in finance.
Explain it simply. What is it?
It's basically the extra return investors expect to get for taking on the risk of investing in stocks compared to putting their money in something considered risk-free, like government bonds or bills.
The reward for taking the equity risk.
Precisely. And this premium is crucial for valuing stocks, for making asset allocation decisions, for companies figuring out their cost of capital.
So what did this 101 years of data tell us about the historical equity risk premium? Was it large?
Yes, historically, over the 20th century, it was substantial in the US and most of the other countries studied. Often cited figures are around, say, 4–6% geometric mean, maybe higher arithmetic mean, depending on the country and the comparison asset.
But that's history. What do experts think looking forward? Is the future premium likely to be that high?
Generally, no. Most surveys of financial economists suggest expectations for the prospective equity risk premium are lower than those historical averages.
Lower. Why is that?
Well, a few potential reasons. Maybe some of the factors driving those high 20th century returns, like massive productivity gains, globalization kicking in, falling interest rates, won't be repeated to the same degree.
A low-hanging fruit has been picked?
Sort of. Also, perhaps risk is perceived differently now. With better diversification globally, maybe investors don't require quite as high a premium as they did in the past when markets felt riskier or more isolated. Prices might already reflect lower future expected returns.
So relying on history could set you up for disappointment.
It could. The historical premium varied a lot, too, if you look at different sub-periods within the century. It wasn't a constant. That variability really underscores that long-run stock returns aren't guaranteed at any specific level.
And this has implications for companies too, right? Their cost of capital.
Absolutely. A company trying to figure out the return investors demand needs a forward-looking estimate of the risk premium, not just the historical one. Using the historical number might make their required return look higher than it actually is today, and a global perspective on this is increasingly vital.
Okay, let's bring it all together. What are the big implications for investors like you listening and for companies?
For you, the investor, the key is strategic asset allocation. If the equity premium might be lower, and maybe real bond yields are different from the past, getting that mix right between stocks, bonds, and other things is more critical than ever.
It's not just set it and forget it based on old rules of thumb.
Not really. And then there are the things you can control. Taxes are a huge drag on returns. So being smart about using tax-advantaged accounts like pensions or ISAs or 401ks is essential.
And fees?
Fees, too. High mutual fund fees can eat up a huge chunk of your returns, maybe even the entire expected equity premium in some cases. Low-cost index funds become very attractive in that context.
Does a lower premium change the active versus passive debate?
It might. Some argue that if the overall market return beta is expected to be lower, then skilled active managers, alpha generators, have more incentive to deviate significantly from the index to try and add value. But finding those consistently skilled managers is the challenge, isn't it?
Always the challenge. What about future risks? Are stocks still worth it?
Oh, equities will absolutely remain risky. Business is inherently uncertain. There will be new global challenges we can't foresee. But yes, a positive equity risk premium is still expected long-term, just likely more moderate.
So the advice is still long-term, diversified investing.
For most people, yes. Holding stocks for the long run as part of a portfolio diversified across assets and countries still makes sense. Just manage your expectations about the level of return.
And for companies.
They need that realistic, forward-looking view of the equity risk premium for their cost of capital calculations. Using outdated historical numbers could lead to bad investment decisions. And think about pension plans, too.
Right. Lower expected returns mean they need to reassess funding and allocation.
Exactly. It has major implications for pension sustainability.
Okay, any final sort of laws in the market from this century of data?
Well, that survivorship bias worry. The authors argue it's probably overstated in terms of its impact on the global average return, as the truly failed markets might have been small globally to begin with.
And the reason for those high historical premiums?
Likely a mix of things. Real productivity growth, better corporate governance evolving over time, technology, maybe a fall in the required return itself as risk perception changed and diversification became easier. It wasn't just one thing.
So wrapping this all up, what's the single biggest takeaway for someone listening?
I think it's this. The 20th century was overall a triumph for optimists, especially equity investors in places like the US, but don't assume the next century will simply repeat that performance.
Future returns might be more moderate.
Quite possibly. Understanding why past returns were what they were and the potential biases in the data is crucial for making informed decisions today. Don't just extrapolate the past blindly.
That's a really vital message. Okay, a final thought for people to chew on.
Maybe think about this. How might today's big shifts, AI, climate change, geopolitical realignments, how might those things change the risk premium and the relative appeal of stocks versus bonds versus other assets in the decades ahead? What are the big surprises the next 100 years might hold for us as investors?
Definitely food for thought. Predicting the future is impossible, but understanding the past helps us frame the questions.
For anyone wanting the full detailed picture, the book Triumph of the Optimists is really the place to go. It's dense, but fascinating. Consider how these long-term lessons apply to your own strategy. Thanks for joining us on this deep dive.